In the US, the $34 billion worth of tariffs that the US is imposing on Chinese goods come into effect. We're not seeing a lot of explanation out there about what it actually means for Australian markets and for potentially for Australian investors as well. What's your take there?
Yeah, well, Glenn, it is serious. I mean, don't forget the interest rate movements and bond yields, that's serious enough. But overlaying that, we have this problem. Again, something we haven't seen for a long, long while. The world has benefited significantly from globalisation. Trade has freed up, and the movement of goods and services around the globe has created significant economic growth and significant wealth for the world. Now we have some interruption there. The US and China, in a face-off. Now, whether that escalates or not, who knows? You've got two fairly arrogant and aggressive, personalities there. Neither looks like they want to back down. So we are kind of, I'm not saying at flashpoint. I don't want to get too kind of, get too excited and sensational. But the thing is that, from Australia's point of view, if we look at where China's economy is now, we all know it's got a lot highly leveraged. But strangely enough, the imports and exports, which are big, they're in trillions of US dollars, the net exports don't contribute all that much. In fact, 9% to GDP. The two big elements of GDP growth are consumption and fixed asset investment, capital creation, right? So consumption is about 55%, investment is 32 or 33%, and then you've got the net exports. Now, and that's as the Chinese economy's evolved from rice paddies, if you like. People have moved to the city, migration and what have you. So infrastructure's done that. And so initially, going back 10 or 15 years ago or more, investment was a big creator and big driver of GDP growth. Then consumption has taken over as it's become more westernised and more developed economy. Now, import-export industries, they employ a lot of people. Disturb that, and the impact on consumption, which is Chinese consumption, which is the main driver of the economy, because fixed asset investment is coming off, because you could argue that the majority of China's investment in fixed assets and infrastructure is gone. There's still plenty to do, but the majority of it's gone. So consumption's becoming more and more important. Disturb the consumption part, in other words, people haven't got a job or what have you, then you get the backlash. In Australia, there'll be less demand for our exports, but specifically our resources. And so that's where we'll get washed up in it. But we're in a good position, don't forget, being so close to and in the same time zone as Asia and East Asia, and that's our big trading partners. Tourism is going to be very good for us and what have you, but disturb the consumption patterns, and that's where we could see some problems.
And none of these other pieces are arguably going to be big enough to make up for any shortfall in that bigger picture?
Well, no, because number one and number two exports are, iron ore at 63, 64 billion and coal at 55 billion. If you get, 10 or 15% off those, they make a big hole in our terms of trade, and the currency will come under some pressure as well. So, so Australia's a bystander, but it'll get hit with a backwash.
Sure. You've alluded to it a little bit, but in terms of, so you're talking about bond yields, but what does all of this mean for bond yields and for interest rates?
Well, I mean, in Australia, the central bank here hasn't got the problems, hasn't got the assets on its balance sheet that it doesn't need, but it also has got, the cash rate at an all-time low. But it's got a different situation, unlike in the US. In the US, the corporates are highly leveraged, and they're buying a lot of their stock back with debt, which is very dangerous. But their households aren't very leveraged at all. Our situation is that we've got a household sector that's very leveraged, very sensitive to increases in interest rates, despite the fact that we've got an economy that's growing at somewhere 2.75 to 3%. Inflation doesn't seem to be a problem, but we've got wages growth below par. We've got expenses in the household, increasing at 2 and 3 times wages growth and inflation. Household incomes under pressure. The central banks here won't be doing anything, I don't think, for at least a year. But out of cycle interest rate hikes are highly likely, and I'd say before the end of the year you'll see banks move on the variable mortgage rate. That's not going to be good news for consumption here or households. Our bond yields, like our 10-year yield, is below the US. That's happened in 1998 and in 2000. Both of those situations, the currency was below 60 against the US. Now, yes, there's been a big China influence since, so it's not really strictly comparable, but that interest rate differential is not positive for the $8 US cross. I think that the $8 could come a bit lower, probably 70. It might even have a 6 in front of it at some stage, but I don't see it going north.
And yeah, just finally, so where does that leave us? Do you increase cash? Do you buy gold? I know we don't want to get into too many specifics here, but...
No, well, I mean, in December when we last did a forecast video, I said that I thought that the US and Australia markets would finish 2018 below their exit of 2017. That looked a bit silly back end of January with the markets on the tear. Things have normalised a little bit now. I don't see any reason to change that forecast, because we have this second half of the year could get quite volatile and a little bit nasty, and so I think that you should be raising some cash. The most consensus out there sees the ASX 200 at 6,600 by the end of the year. That from where it is now is 5%. So 5% upside against a possible downside that could be anywhere between 15 and 30%. Now, on that scenario, I think you have to say that you should be taking money off the table, getting your portfolios in good shape, make sure you're holding quality assets, and build some cash.
Thank you. Well, we look forward to reading all the details on that and really getting down to some of the more micro level as well later on, both in this existing report and in the one to come once the earnings season hits.
Yep.
Thanks, Peter.
Pleasure, Glenn.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.